Hi, thank you for watching Digging to China. I'm Dong Shong. If you have not done so already, please subscribe to my channel. Thank you very much. The economic indicators for China in November paint a bleak picture. The Purchasing Managers Index (PMI) continues its downward trend, registering at a mere 49.4%. The Consumer Price Index (CPI) presents a more concerning scenario with a half-percentage decline both on year-on-year and a month-on-month basis. The Producer Price Index (PPI) has remained submerged throughout the entire year, and the corporate profits show a consistent decline. Let's revisit the trends in various data, and it's clear that in the latter part of this year, there was only a slight economic upturn in September, followed by a continued downturn. If we reflect on the period from the beginning of the year until now, there has been a consistent optimistic narrative every month, ignoring the evident economic deflation. Instead, a new term, weak recovery, has been coined to characterize China's economic development this year. In reality, every ordinary person knows that the Chinese economy is indeed facing deflation, and this trend may persist for many years. This is attributed to the influence of the economic cycle and, secondly, the misguided economic control policies implemented by the Chinese Communist Party this year. It seems every step has gone awry, with no semblance of predictability. Perhaps it's time for Beijing to refrain from inference. Even a monkey could do better. Today, let's take a closer look at the economic decisions made throughout the year and examine how the Chinese Communist Party misjudged each step. Firstly, let's delve into the trajectory of China's economy this year and examine how it has unfolded. As a manufacturing giant, China's deflationary trend cannot be solely assessed through the Consumer Price Index. The CPI represents the outcome, while the Producer Price Index serves as the underlying cause. In simpler terms, the CPI is influenced by the movements in the PPI. Analyzing the patterns of CPI and PPI, it becomes evident that the PPI experiences a decline first, subsequently pulling down the CPI. This indicates that the business initially observed a challenge in selling goods at existing prices, compelling them to sacrifice profits for the sake of maintaining sales volume. With profits dwindling, businesses are compelled to reduce operational costs to sustain themselves, leading to salary cuts and layoffs. Consequently, as people experience a decline in income, consumer spending naturally contracts. Simultaneously, investments decreases, triggering a decline in housing prices and a downturn in the stock market. At this juncture, the Chinese Communist Party made its first misstep by imposing controls on housing prices, prohibiting real estate companies from reducing property sales price. This immediate consequence resulted in property price deviating from market values, leading to a decline in transaction volume. Real estate companies found themselves without adequate revenue from sales, making it difficult to acquire new land. Consequently, local governments had to arrange for state-owned and central government enterprises to acquire land at high prices, essentially providing a financial lifeline to the local government's land finance sector. However, this decision introduced another hidden risk by undermining the financial stability of state-owned and central government enterprises. This situation made it challenging for these initially robust state-owned real estate companies to acquire struggling private enterprises later on. In the last 2 months, even the most prominent state-owned real estate companies nationwide have been closing or merging city branches, implementing layoffs and downsizing. Their financial reports universally paint a grim picture, with a common issue being the accumulation of excessive land acquisitions without corresponding development progress. Despite having access to cheap funds borrowed from banks, their debt-to-asset ratios are approaching the critical threshold of 70%. If property prices experience a further decline and assets shrink, these companies will immediately lose their ability to secure financing. Take the Jinmao Group in China, for example. It's a central government-owned enterprise currently navigating a self-rescue mission. Jinmao Group, once known for its high-end real estate developments that quickly gained national recognition, is now grappling with considerable challenges. Jinmao has consolidated its 7 regional companies into just 5. The city branches of the company have witnessed almost a 50% reduction in staff, and the net profit for the first half of the year has seen a staggering 83% decline. Additionally, the debt-to-asset ratio has surpassed the critical threshold of 70%. Consequently, even these formidable state-owned enterprises in the real estate sector no longer possess the capacity to purchase land and financially support local governments as they once did. As we enter the latter half of the year, local governments found themselves under mounting debt pressures, to the extent that some collectively sought assistance in Beijing, ultimately compelling the central government to step in with financial aid. However, the unfortunate outcome of cash-strapped local finances is that the local government typically starts cutting expenditures in public welfare. For example, in Zhengzhou, even commitments to maternity subsidies were neglected. Naturally, when citizens receive such alarming signals, they tend to adopt a defensive stance, prioritizing saving and reducing consumption, since they came to realization that reliance on the government and the state is increasingly uncertain. On the flip side, apart from cutting down expenses, there is a need to boost revenue. The CCP has opted for 2 strategies in this regard. Firstly, imposing more fines and extracting money from the citizens. Second, expanding state-owned enterprises. A convenient way to expand state-owned enterprises involves increasing the prices of upstream raw materials, since these raw materials are largely under the monopoly of state-owned enterprises. A survey among private enterprises in China revealed a unanimous concern among business owners. They consistently cited the soaring prices of raw materials controlled by state-owned enterprises in the upstream sector as the most severe factor constraining their own development. In essence, the CCP is sacrificing the very source of its prosperity. While state-owned enterprises see increasing profits, it comes at the expense of crushing private enterprises. Simultaneously, they hypocritically espouse slogans in support of private business while their actions contradict their words. Ultimately, private enterprises suffer, dragging local governments down with them. Considering that private enterprises account for 80% of employment in China, the adverse effects of this strategy are evident in the rising youth unemployment rates, which have become so severe that data is no longer publicly disclosed. Public discontent is on the rise, leading to a decline in childbirth rates and reduced consumption. Over time, these sweeping changes will adversely impact the stability of CCP's governance. Consequently, the costs of maintaining stability escalate each year, pushing the finances into a detrimental cycle. The above is a partial overview of domestic issues, and one might contemplate whether it's a series of interconnected challenges where each link seems to falter. It appears that there is no aspect done right, yet it also seems that getting it right is elusive, and every move appears to be a desperate attempt, akin to a sense of inevitability. Whatever is done, it seems to be wrong thing, and whatever is attempted, it appears futile. After addressing domestic economic concerns, let's shift our focus on export-related issues. If we exclusively consider export data, it's evident that the situation is quite challenging. Now, let's examine the ranking of the United States trade partners for this year. China has been the top exporter of goods to the US since 2009, but this year, China lost its title. The top-ranking trade partner is the European Union, constituting 18.5%. Following closely is Mexico, making up to 15.2%. In third place is Canada, accounting for 13.5%. China, coming in fourth, represents 13.2%. In recent years, it's an undeniable reality that China is gradually losing its share in the American market. Interestingly, this outcome can be attributed to the concerted efforts of the Chinese government. This year, Chinese export enterprises, in a bid to secure orders, have had to compromise on profits by engaging in price competition, with the government stepping in to subsidize and ensure their survival. It raises the question of whether this annual government subsidy for export enterprises is still a necessary practice. In my view, it's no longer essential. Redirecting these funds towards improving the well-being of the ordinary citizens would be a more worthwhile endeavor. Reviewing recent news, the European Union has initiated an investigation into anti-subsidy practices concerning Chinese electric cars. Unfair competition of this nature faces opposition on the global stage. Furthermore, the rules of the global game suggest that the era dominated by Made in China has come to a close. Historically, international capital tends to enter when a country benefits from a demographic dividend and it departs when that dividend diminishes. This historical pattern was observed in Japan, Taiwan, and South Korea, where each manufacturing nation followed a similar trajectory. However, Japan, Taiwan, and South Korea successfully underwent industrial upgrades, ultimately achieving developed nation status. What about China? The supply chain is shifting towards India, Vietnam, and Mexico. Just consider the age demographics of their population. India boasts the youngest average age at 28 years old. Mexico follows with an average age of 29, and the Vietnamese average age is merely 33. In contrast, China's average age stands at almost 39 years, relatively older. So, depending on subsidies, exploiting export enterprises and engaging in price was internationally against these competitors. How sustainable is this strategy? Capital's long-term strategies consistently focus on macro-level data, and no one can alter these inherent patterns. Guided by the CCP, many Chinese tend to underestimate India, Vietnam, and Mexico. There is a perception that these countries are inferior to China and lack the capacity to take over as the world's manufacturing hub. Yet, looking back at the 1990s, when entrepreneurs from Hong Kong and Taiwan first established factories in China and encountered Chinese workers, they too initially held similar sentiments, expressing complaints about the perceived shortcomings of Chinese workers. However, what unfolded afterward? The transformation was evident. The people can indeed adapt. The notable distinction might be the Chinese individuals are perhaps more easily trainable, becoming skilled workers within a shorter time frame, while individuals from India might require a longer period for a similar transformation. A compelling proof of this is, if these countries were truly as problematic as some perceive, why would capital invest there, and why does investment continue to expand? Are these capitalists not as astute as you? At present, India's per capita GDP is only around $2,000. Based on historical patterns, manufacturing nations typically face a significant challenge when their per capita GDP reaches $10,000. Crossing this threshold marks entry into developed country status, while failing to do so results in abandonment by capital. Hence, there is still promise in investing in India at the moment. However, investing in China carries higher risks, given that China's per capita GDP has already surpassed $10,000. After India, Vietnam, and Mexico potentially take over China, can China, constrained by Western technological limitations, still manage industrial upgrades and navigate the middle-income trap? Presently, the Chinese Communist Party has pinned China's manufacturing hopes on the electric vehicle sector, channeling resources aggressively in an attempt to reshape the country's destiny. Nevertheless, this strategy may also prove to be flawed, and it won't be long before observers witness the unfolding results. Let's recap this year's macroeconomic decisions in China. Almost every move has been a misstep, and the government has emerged as a significant disruptor to the economy. Initially, the adamant refusal to allow real estate companies to lower prices for sales resulted in the downfall of the entire industry, affecting state-owned enterprises and preventing robust top-tier state-owned real estate companies from acquiring bankrupt ones to stabilize the sector. Faced with fiscal challenges, the government opted to increase fines and then let state-owned enterprises raise raw material price to generate profits, further harming private enterprises. In terms of cost-cutting, welfare expenditures were slashed, once again undermining the confidence of the general public and accelerating the onset of deflation. Lastly, the government's reluctance to address the reality of supply chain migration forced export enterprises to sell at reduced prices to maintain the supply chain at the expense of more fiscal subsidies and protests against anti-subsidies from other countries. In summary, the situation can be characterized in two words: short-sightedness. The emphasis is solely on the present with little regard for the future. A government adopting such an approach when confronted with difficulties is likely to lead its people into the depths of poverty and hardship. Honestly, it might be more effective to have a monkey in charge. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.